Hello, everyone. Happy New Year's Eve. Today, I'm going to be talking about whether or not it's a good idea to invest in a variety of markets. Let's get started. Welcome back, everyone. So, this is a pretty important episode. I think a lot of people, as they go about scaling up their rental portfolio, they get to think about, should I buy in a variety of markets? Should I focus in my backyard? Should I focus in one market out of state? What's the path, right? And it's a really important question because as you do scale up your portfolio, I think we can all agree that there is some benefit of diversification. But how do you go about doing it in real estate, and is it the best move? And so I want to hit on a few things today. And it's really important that you watch through the entire video because in the end, I'm going to show one of the main reasons why we do this, okay? Or why you would invest in multiple states. Think about the markets as the primary, secondary, and what is known as tertiary, or like the third tier, right? The primary markets being the big metros, the biggest MSAs, LA, San Francisco, Seattle, New York, Denver, those massive markets, right? Now Austin and Dallas. And when you think about like secondary markets, think about markets that are not quite as large, maybe between populations of 250 to 750 in that range. And it varies by all sorts of different metrics. But these would be examples of something like Orlando, maybe something like Atlanta. Even Atlanta could be arguably a primary market. But they're bigger markets, but they're not the biggest of our MSAs across the nation. And if you're curious about what MSA means, MSA is essentially the broad citywide area of a city, right? So like San Francisco, right? I'll have to double check this, but for example, San Francisco is just one part of the MSA. The MSA would be called the Bay Area, which includes Oakland, Berkeley, San Francisco, and whatnot, right? So, and when you think about tertiary, you're thinking about the smaller markets, but things like Indianapolis would be one, Cleveland, the smaller markets, but still important markets, okay? And so I tell you this because if you look out there in the market today, the hard thing that we all have is trying to find good deals. What is a good deal? To me, a good deal is anything that has purely just cash flow return on your investment of at least 14 to 16%. Now, back in 2015, 2016, in that range, you could find deals, good deals, B class, even occasionally A class, that were returning 14, 15, 16% on your money. So what I'm saying is, if you had put in $20,000 as an investment, you were getting out something around $3,000 to $4,000 back per year on your money, right? It's around a 15% return on your money. Today, those margins have contracted substantially by about 2/3. So now what once was a 15% return is now down to 5, 6, 7, maybe 8% on your money. So the deals are not so easy to find, okay? Now, in our other videos, we talk about how to measure real estate return, but for point of simplicity, I want to first mention that the deals are hard to find out there, mainly due to one, cheap cost of debt. Loans are at all-time low interest rates. There's a massive inventory supply, so we know that, and there's a lot of new first-time investors. So there's a lot of headwinds in as a buyer trying to find good deals. So I say this because the idea of investing in your backyard is going to be really hard, right? So one, simply just due to the current market dynamics, you're probably going to have to explore other markets. But how best do you do that? Okay. Now, the first thing I think of is, okay, how many properties can I handle in the next 3, 4, 5 years, right? So the first thing you want to think about is, what is your long-term goal? If your goal is to have 10 properties, okay, well then you could afford the opportunity to expand in other markets. And I say that because when you expand into other markets, you don't just buy one there and one over here and one over here. It's hard to scale up that way. You don't really get a chance to intimately know the market. You don't get a chance to network and meet the people that really matter in the market by simply just buying one. What I have always told my clients is, let's say you have a goal to own 12 properties. The most I believe you should be owning is up to 4 markets, right? Now, I personally own in 4 markets, but that's just because that's how it's grown over time. I'll probably stop there for some time and just expand within those markets, right? And there's a number of reasons that you would do this. The first one is, think about tax returns. Every new market you enter requires you to have a new tax return every year. Now, a lot of markets have relatively affordable tax filing cost, But if you go into the pricier markets, like in the Northeast, it can be very expensive, $1,000 to $2,000 to file your taxes per state. So if you have 4 properties, and let's say you'd happen to be in a high cost state for tax filing, you could be spending $2,000 to $4,000 just on your tax filing, which wipes away the majority of your returns. So the cost of filing taxes can be a major hindrance if you're just scaling by one, right? So what I'm saying is, if you're going to scale into markets, buy 3 or 4, at first, then set up an LLC, protect those 3 or 4, file a tax return for that LLC, and then rinse and repeat to another market. 3, 4 markets should be the max you should do. Should be the max that you'll be, expanding into. Now, the really important part I want to talk about today is the importance of what is called population migration, where people are moving to. And I'm going to show a graph here, and you can see something that's really important, right? And I gave this presentation about 2 years ago. So that was 24 months. And I said here within 60 months, we're going to start seeing this really come to fruition. And what you see here is that, and this is by John Burns Real Estate Consulting Firm, who is a fantastic firm in regards to real estate research. But you can see that between the Southwest, Phoenix and whatnot, Texas, and really the Southeast, that's going to be 62% of the overall population growth. Now, there's some hubs in the Midwest. Kansas City, Columbus is doing quite well. I think Cincinnati's got a lot of upside. But the majority of the people are moving to the South, Southwest, Southeast. Now, what does that mean? Well, look, I'm not one to bet on price appreciation, but if you're going to do it, it's all about supply and demand. There's going to be a lot of demand in the Southwest, South Texas, and the Southeast, right? So that's going to put pressure on the prices of the assets. Now, if you're smart, you're thinking about buying in those markets, and maybe you pick a Midwest city for cash flow, but you're buying in the Southwest, South, and the Southeast to get ahead of the population curve. Now, this study is through 2025, so you're already in the beginning of the migration. COVID has sped things up even faster. So we're already seeing the migration happen to these areas, and with it, substantial price increases, which is very noticeable in places like Phoenix, Dallas, and Austin. Okay, so really important there. Another fact that I want to share with you is that of the 12.5 million households or new households through 2025, 8 million of them, give or take, will be in the South. Okay, so Southeast, Texas, Florida, and Southwest. Powerful numbers. You have to be considering if you're, to expand into other markets, because the growth that's happening in these markets, that's going to be a very attractive play from an asset price standpoint. Now, lastly, you can see here another chart. The developers are all planning the same thing. They're planning permitting and development in these areas because they know that's where the money is. And if there's any way to understand where to put your money, is you follow the big money, the big boys who have all the research analysts behind them, and see where they're putting their money. So I'm saying this because some people don't want to focus on other markets. I think because of these stats, you have to begin to think about Texas. You got to start thinking about Southwest, around Phoenix or New Mexico or Florida or part of Atlanta, places that are growing like gangbusters to capture the upside here. Okay, so I just wanted to let you know that's my take. I'm all for investing in multiple markets, but you got to do it in a way that makes sense. So scale up to avoid the extra costs and taxes, and I think ultimately you'll have a nice portfolio, built for yourself. Thanks.